Hello everyone. A couple of days ago, we saw the non-farm payroll data for February. The job market in US appears to be very good. The economy is good. The stock market in general is going up, but is everything as good as it seems? That's the topic we're going to explore today. So this article comes from the International Monetary Fund. According to this article, in 2024, the global economy is expected to grow 3.1%, with the inflation moderating more rapidly than anticipated across all regions, creating a pathway to a possible soft landing despite elevated central bank policy rate. And this chart is coming from Atlanta Fed. It's called GDP Now. It's a mathematical model that predicts the GDP of the next US quarter. As we can see, the latest data is for Q1 2024. This mathematical model is expecting a GDP of 2.5% for Q1 of 2024. So everything seems pretty good. And if we look at the earnings season we just had, based on those data, based on the earning calls in that earnings season, FactSet has recently analyzed that data and is showing us this chart, which shows number of times the term recession is mentioned in the earning calls in the S&P 500 companies, as we can see in the most recent quarter, which is Q4 of 2023. The word recession is only mentioned 47 times, and we can see since Q2 of 2022, it's been on a downtrend. So this chart shows the perspective of corporate America. They are also extremely optimistic. So this is the non-farm payroll data which is received for February in the US. The left column shows you the actual data we got from the report. The right column is the estimation come from Wall Street and the economists. We can see that the change in payroll in February compared to the previous month is 275K, which is better than the estimated 200,000. So on the surface, it doesn't look like a hot job report. But if we look at this employment rate, it's actually higher, right? We got 3.9% compared to the 3.7% estimation. So we're going to come back to this unemployment rate. But if we just look at the payroll numbers, it is a pretty good report. And on Friday, when this report was released, on the first half of the trading day, the major U.S. indices, they were all going up. And so initially it was observed as a positive report. And in this chart, it shows us the non-farm payroll month-over-month net change for each month. So the rightmost bar here is the February data. So on the surface, everything is pretty robust because the three most recent months, they are pretty good numbers. But the negative side of the report, or the imperfection of the report, can be seen here. So one of them is that there is a noticeable downward revision of last month non-farm payroll data in January. So every time they release a new data, they show you the revision of the previous month. So in January, which is the last report, which is shown here, the revision is actually down over 100K over here. So the initial reporting of January, which is over here, is about 353,000, but it's been revised down to now 229,000. So it's down 35%. And besides that, the unemployment rate we were seeing is above the estimation. So we got 3.9 versus the 3.7 expected. And what's really interesting is the 3.9, which is received, is actually the highest unemployment rate in the past 2 years. So in this chart, we can see last time it's higher than 3.9 was in January 2022, which was 4%. So highest unemployment rate in 2 years. So let's see what James Bullard said about this whole situation or this report. So James Bullard is the ex-Federal Reserve President of St. Louis Fed. He was one of the most popular Federal Reserve officials during the pandemic era, as he was one of the first ones to talk about front-loading the interest rate when the inflation was flaring up and the Federal Reserve wasn't doing anything, wasn't raising rates. And this guy came out to say, come on, guys, we need to raise interest rate quickly with large hikes. That's larger than 25 basis points. So he was known for that. Now James Bullard, after he retired, he's now a professor at some universities, but he did come out giving us his opinion about the February non-farm payroll data. He said, I see this as increasing the probability that the Fed acts a little bit sooner than previously anticipated. His stance comes from the unemployment rate we talked about being 3.9%. And James Bullard said the Fed should move sooner and slower, taking the first 25 basis point cut without promising a whole bunch of other moves coming. He said the risk for the Fed is that it gets behind on rate cuts. If the economy normalizes over the second half of the year, it would be awkward for the Fed to have an inflation close to 2% with Fed's benchmark policy rate in the range of 5.25 to 5.5%. He's saying, come on, if the second half of the inflation go towards 2%, you still have a Fed funds rate of 5.5%, that would be a joke. That's essentially what he's saying. Now, we have one of the most hawkish member right now is the Minneapolis Fed president, Cash Curry. This person suggests that the current level of the Fed funds rate might already be the neutral rate for today's economy. So he's saying 5.5 is the neutral rate, meaning it's a rate that's not putting pressure, downward pressure on the economy, and it's not putting any upward pressure either. It's neutral. But Bullard is saying that, sure, our neutral rate must be or may be higher than historically suggested 2.5%, but there's no way where our neutral rate is at 5.5%. That's way too high. So essentially, James Bullard is telling the Fed, the current Fed officials who are working right now, not to make the same mistake that they made during the beginning of the pandemic, where they were 1 year behind on their monetary policy in terms of rate hikes. Okay? We had inflation going up for 1 whole year before they hiked interest rate for the first time. That was a huge mistake because we are experiencing one of the worst inflations in 40 years. Now, but if we take another look or from a different perspective about Bullard's cautionary concern over the unemployment rate, we can look at this thing called Sam's rule. So the Sam rule. So Sam rule is invented by this person, Claudia Sam. So in this rule, historically has reliably predicted a recession or signaled recession. So according to this person, Claudia herself, on Twitter, she's saying her Sam rule did not trigger. So this rule does look at actually looks at unemployment rate to signal the recession. Right? So she's saying we are not there yet. So this is the picture she shared on Twitter or X.com. As we can see, she's saying that her rule did not trigger. Her rule, look at the 3-month moving average of unemployment rate relative to to its low during the previous 12 months. So if the 3-month average, moving average of the unemployment rate is over 0.5% higher than the 12-month low, and then the SAM rule triggers, signaling that we're in a recession. So if we look at the historical performance of her indicator, it's actually accurate 100% of the time since 1948. So where we are right now is here. And if you look at the orange line, which is the trigger, the 0.5%, we are actually getting there, but we're not there yet. So that's what she is saying. The indicator is not alerting us right now. It's not being triggered, but we are getting there. So as a conclusion of this video, I think it's very important to have the retail investors reminded about the risks we're having, because we're definitely navigating through a very abnormal economic environment right now, because we just experienced the most inflationary period in 40-year history, and the Federal Reserve, the Fed funds rate is currently at 5.25 to 5.5%, which is very high for the past 40 years. What we have learned in history is that whenever Federal Reserve makes such drastic moves, right? Like for example, right now, the high interest rate, it usually doesn't end up very well for the economy and for the stock market. And the fact that our unemployment rate just risen to 2-year high is presenting a lot of risks and uncertainties in the future. So I believe for retail investors, they should consider embracing diversification if they haven't embraced it already across different equities, like different stocks. You maybe use ETFs and maybe put some money in the fixed income, and maybe even alternative investment like real estate. So that cross-asset sort of diversification is going to help mitigate some of the risks. So at the current high interest rate, I personally think holding on to some fixed income does not feel like a super challenging job, because a lot of for example, the cash ETFs, they are paying 5% annual return. So it's not that difficult, even though, yes, our high inflation cancels out a lot of the gains from the cash ETF or the fixed income. Thank you very much.